Gas prices have reached record highs. Shipping lanes are disrupted. Global supply chains are under serious strain. The 2026 Strait of Hormuz crisis has effectively removed nearly 20% of global oil supply from the market, sending oil prices to $126 per barrel, driving up fertilizer costs and pushing freight rates to multi-year highs. Energy costs are squeezing household budgets from Europe to Asia to the Americas. Every financial headline is calling it a crisis. Every economist is warning of pain ahead. And on the short-term numbers, they're right. But what if the short-term data is only half the story? What actually happened? In February 2026, escalating geopolitical tensions triggered the closure of the Strait of Hormuz, a 21-mile choke point through which roughly 20% of the world's oil supply travels. The shutdown was immediate and consequential. Tankers halted, marine insurers pulled coverage, supply chains that had been running on tight margins snapped under the added pressure. Energy, food, transport, and manufacturing costs all moved sharply higher in a compressed timeframe. From a pure market mechanics standpoint, it was one of the most concentrated supply shocks in modern history. Why markets have seen this before and what happened next. Here's what financial history tells us that the daily headlines tend to miss. Major commodity shocks have a consistent two-phase pattern. The first phase is severe disruption and price pain. The second phase, the one that quietly reshapes entire industries and asset classes, is the capital reallocation that follows. Consider the 1973 oil embargo. In the immediate term, it was a genuine economic catastrophe. Inflation surged, equity markets sold off, GDP contracted. But within that crisis, a wave of capital began flowing into previously marginal investment categories: energy efficiency, alternative power sources, and industrial process redesign. The Netherlands built out infrastructure that permanently reduced fuel dependency. France redirected state capital into nuclear power generation at scale. Denmark began what would become a multi-decade investment in wind energy, a bet that ultimately produced one of the most competitive clean energy export industries in the world. None of this was idealism. It was capital following incentives, because expensive oil made previously uneconomical alternatives suddenly very economical. The 1979 oil shock reinforced the same dynamic. It accelerated funding into energy research, drove the creation of new government energy agencies with real budgets, and launched efficiency programs across housing, transport, and manufacturing. The industries built during those two crisis periods, now employing millions globally, trace their origin directly to the investment decisions made when oil became painful enough to take seriously. The 2026 investment case in real time. Now, bring that framework to the present. Renewable energy investment was already growing at a strong pace before the Hormuz closure. What the crisis has done is fundamentally change the investment thesis from an ESG consideration to a capital allocation necessity. That is a much more durable shift. ESG-driven investment is subject to political cycles and sentiment changes. Energy security-driven investment is not. It is backed by national budgets, long-term procurement contracts, and hard industrial logic. The arithmetic is straightforward. At $30 per barrel oil, solar and wind compete on environmental grounds. At $126 per barrel oil, and potentially higher, they compete on pure cost. For industrial energy consumers, utilities, logistics companies, and large commercial real estate operators, the business case for electrification and efficiency investment has moved from attractive over a long time horizon to immediately accretive to the P&L. That shift in the corporate decision-making calculus is what drives durable capital flows, and those flows are already accelerating. Battery costs have fallen 97% since 1991. Solar installation costs have dropped to levels that make it the cheapest new electricity generation capacity ever built. Electric vehicle total cost of ownership has crossed parity with internal combustion vehicles in a growing number of markets. These were already strong investment trends. The 2026 shock is the catalyst that compresses years of adoption into a much shorter window. The efficiency dividend. There is a second financial benefit that deserves more attention than it is currently receiving. Oil price shocks are historically the single most effective driver of energy efficiency gains, and efficiency gains are permanently deflationary for operating costs across the entire economy. After the 1970s shocks, global oil intensity, the amount of oil required to produce $1 of real economic output, fell by 60% over the following 2 decades. Industries restructured their production processes, buildings were insulated, engine efficiency improved dramatically, logistics networks were redesigned. The result was a sustained reduction in the energy cost embedded in every unit of economic output, which contributed to the productivity growth and disinflationary environment of the 1980s and 1990s. The same efficiency pressure is now rebuilding across every sector. Capital expenditure decisions that were being deferred, fleet electrification, building efficiency upgrades, smart grid investments, precision logistics, are being accelerated because the payback period at $126 oil is substantially shorter than at $60 oil. Every dollar spent on efficiency now is a dollar that permanently reduces exposure to the next oil shock. From a corporate finance standpoint, that is a very compelling risk-adjusted return. Who wins in this environment? Not every portfolio is exposed to this crisis the same way, and a serious financial analysis has to account for the winners, not just the losers. Energy producers are the most obvious beneficiaries in the short term. Elevated oil revenues are flowing into producing regions and companies at a significant rate. But the more interesting story is what that capital is doing next. A meaningful share of it is being reinvested into diversification, including into renewables and alternatives, because sophisticated energy companies understand that long-term asset values depend on staying relevant in an energy mix that is structurally shifting. On the geopolitical side, nations that secured favorable energy supply relationships ahead of the crisis through bilateral trade agreements, long-term contracts, and strategic positioning are now holding substantial economic leverage relative to those that did not. That leverage will translate into trade terms, investment access, and financial relationships that extend well beyond the duration of the current disruption. Crises accelerate realignments that were already forming slowly and position the prepared ahead of the unprepared. Resilience as a financial asset. The 2026 crisis is also forcing a long overdue investment in system resilience, and resilient infrastructure has measurable economic value that is chronically underpriced until a shock makes it visible. The U.S. Strategic Petroleum Reserve, created directly in response to the 1970s shocks, has already released 400 million barrels during the current disruption, meaningfully cushioning a price spike that would otherwise have been more severe. That buffer was built with capital deployed in a previous crisis. It paid dividends in this one. Similarly, the structural responses to the current shock, pipeline rerouting, alternative supply agreements, agricultural technology investment to reduce petrochemical input dependency, naval logistics programs, are all building buffers that will reduce the severity of the next disruption. From a macro financial standpoint, that is exactly how crisis capital should be deployed, not just in reaction to the current shock, but in reduction of exposure to the next one. Norway's response to its 1980s oil price crash is the cleanest case study. Rather than simply waiting for prices to recover, the Norwegian government and private sector channeled crisis capital into clean technology research and offshore energy expertise. That investment produced world-leading industrial capability in offshore wind, hydrogen technology, and carbon capture, sectors that are now among the highest growth areas in global energy markets. Norway didn't just survive its crisis, it used the capital and attention that crisis generated to build an entirely new industrial base. The honest counterpoint. A credible financial analysis requires acknowledging the downside clearly. Oil price spikes are regressive. They hit lower income consumers, smaller businesses with thinner margins, and energy intensive industries hardest. In emerging markets, the fertilizer price shock is creating genuine stress on agricultural economics that goes beyond a balance sheet issue. Fuel cost inflation is compressing consumer discretionary spending globally, which creates real drag on near term growth across a wide range of sectors. The transition benefits are also not uniformly distributed. The capital flows into clean energy, efficiency, and resilience primarily benefit investors, companies, and economies that are positioned to capture them. The costs fall disproportionately on those who are not. A financially serious view of this crisis has to hold both of those realities simultaneously. The argument is not that this crisis is painless. The short term financial pain is real and measurable. The argument is that the capital reallocation it triggers, when directed with discipline and long term thinking, creates the conditions for structural improvements that don't happen in low price, low urgency environments. The question for investors and policymakers alike is whether that capital is deployed well or wasted. The bottom line: the 2026 Strait of Hormuz crisis is the largest commodity supply shock of the current era. It is a clear, data supported signal that the global energy system carries more concentration risk, more geopolitical fragility, and more embedded volatility than asset prices had been pricing in. But supply shocks of this magnitude also have a consistent historical track record of triggering the kind of structural capital reallocation that permanently reshapes industry economics. The 1973 and 1979 shocks built the foundation of the modern clean energy industry. The 2026 shock, arriving at a moment when the cost curves of alternatives are already highly competitive, has the potential to be the catalyst that makes the energy transition not a decades long aspiration, but a near term economic inevitability. The data from previous cycles is clear. The nations and companies that invest through energy crises, rather than simply endure them, emerge with stronger competitive positions, lower long term energy cost structures, and more resilient balance sheets. We are in the middle of one of those cycles right now. The signal is expensive, but the information it is delivering about system fragility, about misdirected capital, about underpriced risk is genuinely valuable. The only question is whether the market responds to it. History suggests it will. It just takes a crisis to make the math undeniable.